Hello, welcome back on how to hedge against inflation. Today we're going to talk about stocks. Most commonly, we know of stocks that are available to be purchased on the stock market, NASDAQ, Dow Jones, and these are what is known as publicly traded companies. And these publicly traded companies have stocks. They're shares of ownership of that company. There's also non-publicly traded companies where you can own shares of stocks of those as well, but they're not publicly traded, they're not part of the stock market, so they're more of a private sales between individuals or companies as they acquire. Stocks will hedge against inflation dependent on the underlying business. When you own shares of a company, you are earning a portion of their profits. So if you own a company in the lumber industry, this company owns a tree farm. And as inflation happens, the cost of the trees will increase with inflation. They will then cut the trees down, sell the lumber, and they're going to benefit from this inflation. At the same time, you'll see during hyperinflationary periods, some companies gain significantly more than others. Because in the example of the tree farm, they benefited because they owned assets, real assets. Tree farms, mining companies, all of these companies that own real assets in the sense of actual farms, in the sense of corn production, wheat, chickens, cows. All of these companies usually benefit greatly because they own the hard assets. Other companies won't do as well because they're a secondary business that feeds off of these primary businesses that have the hard assets. So they're not going to benefit as much since their costs will go up on the goods that they're going to repurpose and provide to the market. And they at times get caught in this very difficult period where the cost of the lumber or chicken or wheat goes up very high, but the market is not ready to absorb these higher prices. For example, a lot of farmers recently or last year, 2021, were going through a very difficult time because they had contracts with companies to sell, for example, their potatoes for a set price. But all of their costs, fertilizer, fuel, everything else went up. So they were actually selling the potatoes at a loss. Now, since they renegotiated, or it comes to the period of time where they can renegotiate their contracts, January of 2022, they're all renegotiating their contracts for 40 to 60% higher than previous year's numbers, and they're going to be able to recoup their cost. So there is times where these companies benefit greatly because they own these assets. But there is also times where if they have not the best contracts or handle on the cost of their goods, they're going to lose money in this transition period. Overall, it is the better managed companies will have a better return and they will be more profitable because of inflation. But if they're not managed well, obviously they're going to be hurt because of this inflation. But at the end of the day, these companies will still see an increase in value in general because of this inflation. The one time that it really does hurt them is when there's hyperinflation and then the government does a significant increase in interest rates and these companies have high debt that's coming to renew, then they start hurting. So be conscious of what companies you're buying. That will determine your profitability and how much they increase during this inflationary period. I personally do invest in stocks, but the stocks I invest in are normally not publicly traded companies, they're more private companies. So they do benefit in an inflationary period, but at the same time, when you invest in privately held companies, it is harder to sell the shares of the company. So you have to be more patient when you do that. It's like being a business owner. When you own your own business, you can make a lot of money if you manage it right. But when it comes time to sell your business, it can take a long period of time to sell your business, and sometimes a few years. So there is benefits to owning companies on the stock market, privately held companies, or your own business. I did invest in gold mining stocks and silver mining stocks because I wanted to have a broad exposure to that market, because I feel that that's one of the only markets currently that hasn't seen a significant rise from this inflationary period. All other asset classes had a huge increase, but gold and silver really haven't had what I believe a significant increase compared to the amount of money being printed. As you guys know, you can buy stocks on many different places, through Merrill Lynch, through E-Trade, and there's a lot of options out there. Pick which company you'd like to work with the best. I would advise do not use anything like Robinhood or Webull. They're bad companies. I don't like them, so I wouldn't work with them. You don't actually really own the stuff that you're buying on there. You're just owning the rights to it, but they actually own it themselves. And they, as you notice, they manipulate the market, GameStop and AMC. I don't like working with those companies. But personally, I prefer buying privately held companies. I like syndicating businesses and owning shares of these businesses because you get more appreciation and more tax benefits by owning shares of these privately held companies. So I like going that route because after tax returns, I really like the returns I get. Yes, when you are an employee and you have that offering where they're giving you the ability to buy shares and you do exercise purchasing the shares, yes, those are your shares. And that's a special thing that your company's offering to you. And normally it's actually at a discounted price. So you're getting a discounted price on that. So yeah, that is a good way to, even if you say didn't want to own the shares to the company, it is usually a good idea to buy them because you're getting them at a discount and then just sell them, make that profit. And then you can take that money and put it into an asset that you do want to own if for some reason you do not want to keep your shares of your company. There was a company called Enron. The company, unfortunately, did a lot of bad things. Their employees had lots of shares, worked for the company, had shares within the company, and what the company did, it was manipulating the accounting. And with these large companies, and this is a reason why I don't like investing in many of these large companies, the CEOs and the company leaders are paid based off of the stock price increasing. So when you are pegging on a number to increase, for example, let's just say Peloton, right? Peloton has a crazy high price, and since then, I think has dropped 75% from its high and can drop even further. Because your stock price doesn't mean revenue. Many companies are based off of the perception of future revenue. So your stock price can skyrocket. In that sense, if your CEOs and the people in higher management are paid based off stock price, their decisions are not always in the best interest of how the company is being run. It could be just in the short term on that next quarter. So if you are now the CEO of this company and your bonus is on this next quarter of the stock price going up, you might make a decision that is short term, looks good, but long term, not healthy for the company, where you should truly be focusing on increasing the client experience, increasing the overall revenue over time. But if you're short term, you're like, all right, I'm gonna fire half of our staff. Yeah, your P&L, your profit and loss is gonna look really good for that short period of time because you have all this extra money because you don't have staffing. But now what are you gonna do next quarter when you don't have employees to produce more bikes or you don't have enough employees to actually keep the company going efficiently and offer a great client experience, where then over time, you're losing clients and it's gonna hurt the company and the stock prices then are gonna fall. So that's where I'm very cautious on which companies I invest in because they're not all great long-term. So to go back to Enron, they found out that they were manipulating their books, that they were not truly making as much money as they stated, and the company went bankrupt and all their employees lost all of their retirement accounts. be cautious to not put all your eggs in one basket. But as Warren Buffett says, if you have too many baskets, you're not going to be able to focus on any one very well. So some of the tips I've given so far is avoid companies like Webull and Robinhood, especially. I did say I prefer more private companies, the publicly traded companies. And the last tip I would give you is try to dollar cost average. We cannot time the market. Obviously, we can have a feeling that there's a storm coming, so we can be cautious. But the reality is we don't know if the storm is going to blow over or if something's going to happen. So the best long-term plan is dollar cost averaging. What does that mean? You buy a little bit every week or you buy a little bit every month and you keep on adding. The good times you're buying some, the bad times you're buying some, during the flat times you're buying some. So over time, you're averaging in your price. And as time goes on and you get older and you need to sell your stocks, you'll sell a little bit at a time as well. So you're going to distribute the risk and you're going to distribute the volatility of the market by just dollar cost averaging. There is opportunities where the market could crash. And also, it might be certain sectors. For example, if interest rates increase significantly, companies that are in the process to refinance their debt will go from a low interest rate to a high interest rate. If they're not prepared for that, those companies can go bankrupt. If there's enough companies out there, it'll cause these companies to crash. So in that scenario, that can cause a ripple effect for a crash. Interest rates alone going up will not cause a crash, but it will cause a reduction in price because our profitability will decrease and will make it harder for companies to grow fast. Perception of the market is what determines stock prices. The stock price today is based off of what people think is going to happen tomorrow. Right now, people are pricing in the fact that interest rates are going to go up. So if they do it gradually, it shouldn't be a significant drop. It might be 10, maybe 20%, but it shouldn't be a 50% drop. It would have to be something more significant than that. It would have to be a lot of companies going bankrupt. Other factors where I can see a lot of cracks is the tech industry. A lot of companies in the tech industry are not profitable. You'll see that they have done billions of dollars in revenue, but they also have billions of dollars in expenses. When you look at the difference, they're actually not making a profit. They're not pulling a profit. They're all trying to pull an Amazon, where Amazon for years was running negative and not making money. And then finally they made money and they took over the market. They're all trying to replicate that. But as we see with Peloton, it had a 75% drop and people are predicting that there's going to be an additional 90% drop from where it is today. Because based off of the subscription model, based off of the sales, they don't make enough money to justify how much they're spending, and they don't see a way in the future where they're gonna come to a point where they are gonna make a lot of money. So we have to keep that in mind, is that what could affect the company? And then if this happens, how will it affect this company? Simply put, any companies that have a lot of debt right now that are gonna be restructuring in the next year or two, it's not gonna look good for them because likely they're gonna be restructuring their debt higher. What does that mean? Their base expenses are gonna increase. So they might have to focus their energy on, instead of marketing, pay down debt, which is gonna keep them from growing. So then appreciation of the company is not gonna be there the way it's expected. If the company is already not profitable, it'll be even worse. So then all of these companies are gonna come to the market and say, investors, invest in my company. And your investor is gonna say, well, interest rates are up. You're now making even less money than you were before. So now we're gonna go through what's called a down round. A down round in funding means we're gonna give you more money, but we're valuing your company less than we did previously. So everyone who invested in it before is gonna have almost a reduction in value of what their stock is worth. So we're gonna see that in the stock market prices coming down. All of these factors are possibilities to have the stock market go down. The X factor that is hard to put our finger on is how much money is the government going to spend? Because they're in a position that they have so much debt that they cannot truly increase it that high. because of the amount of money that's owed and due to Social Security, Medicare, and all the other public benefits that are guaranteed by the government for its citizens, they only have so much tax money coming in. They can only raise interest rates so much. So the question then comes to, well, how much are they really going to raise interest rates? And how much are they willing to spend to bail the government out and to bail the private sector out? Because at that same time, if interest rates go up, and even if they do raise interest rates from 2 to 3 to 4 to 5 to 6 to 10, let's just say, if they print money faster than they raise interest rates, we're still going to have that safe gap of hyperinflation based compared to the interest rate amount. Not until we have the interest rate higher than the inflation rate are we going to really truly see inflation being tampered down. And then we're really going to see that curve. So that difference is what matters. And that is why I say dollar cost averaging in buying stocks and owning shares of a company that you know is worth it long term is what matters. Because you don't want to own fiat, you want to own assets that are quality that you will be willing to hold long term. I wouldn't say disrupting the market in the sense maybe people would see negatively. People are becoming aware that the stock market is manipulated in the favor of these hedge funds and anybody that's in with these hedge funds and with the government in with some of these companies. We can see the profits that Elizabeth Warren is making, the profits that Nancy Pelosi is making. We know that they're doing insider trading, which would be illegal for anybody else. And if any of their friends lose money, they tweak the system to help them out, and the taxpayer pays for it. We're becoming aware as a society that the system is not truly in favor of the people. The government should be of the people, that everything's being set up is for the benefit of the people, and we're seeing that it is not in our benefit for the majority. And people are becoming aware and they're becoming self-sufficient. That's why personally, I don't invest in a lot of companies on the stock market. I like owning individual companies that I know are run well. I do buy some companies on the stock market, but I believe that the management is good, ethical, smart. We have to be conscious of what we're buying and who is our counterparty and what is our risk to that counterparty. Are they truly supporting us, or are they somehow in the background manipulating the system and leaving us with the bag? That we'll have to determine. So in closing, stocks can be a great investment to hedge against inflation. I personally like owning individual companies that are managed well. If you subscribe to our newsletter, you'll see that there is times that I invest into companies and offerings, and I invite you guys to invest with us as well. Stay tuned and you'll see these opportunities. Good luck. God bless. See you next time.